I'm one of the co-founders of RealVantage. So we've been running these webinars for a while now with the objective of engaging our investors in exchanging views and ideas relating to real estate investments, right? So given our backgrounds coming from institutional real estate private equity space, there are times when some of our views come across as being counterintuitive for some of our audience, or that our approach is very different. Whichever the case, we hope that you will find these sessions thought-provoking and if not, informative, right? So on logistics, please share your views and fire questions in the chat column on the right side of the screen. Now we're pretty thick-skinned people, hardened by difficult questions thrown our way over the years. So please do not be shy about asking them or sharing your comments. All right. Okay. Okay. The topic tonight pertains to market selection, an exceedingly important first step to maximize the chances of real estate investment success. Right? For that, my colleague Mark will take us through namely two areas. Number one is how the sophisticated institutional investors will approach this topic. Second, how RealVantage as your online co-investment platform approach it in order to secure the most attractive investment opportunities for you. All right. Next, you'll round off by sharing our selected markets for focus and the rationale behind it. Well, Mark comes from a strong background in research strategy and investments, drawing upon years of experience with institutional fund managers, such as Pacific Star and Deutsche Bank, and international advisory firms such as JLL. Right. I noticed that a number of folks joining us today for the first time. So before I hand over to Mark, please bear with me for a brief introduction to our platform. Okay. At RealVantage, essentially, we act as your real estate fund manager. So we play three key roles. First, we source, analyze, and we underwrite real estate investment opportunities. So for each deal that you see, we set out the funding required, the projected returns, and the investment hold period. Right? We typically only look at offshore deals. Right? We haven't really looked at deals here in Singapore at the moment. Right. Next, we do is we actively manage these assets and we ensure that it hits the projected returns. Right. And at the end of the investment period, we seek the best possible exit for you. Right. So we interface with our investors through an online platform. So the investment process, the asset management performance tracking, the deposits and distribution of funds are all done online. So it's a very seamless process. Next is just want to highlight the key value proposition that we bring forth. Right. Firstly, in the area of risk diversification. Yeah. Real estate, as you know, as an asset class, is very capital intensive, but we do it differently. We allow you to come in with smaller quantum sums. Our investments are as small as 25,000. So this gives you a lot of diversification. In addition to smaller quantum sums, you also invest across property sectors and across different countries as well. Right. Secondly, we will actively manage the asset throughout the investment life cycle. As you know, real estate is very asset management intensive, and it needs a lot of hand-holding on the asset, right? So we do all that for you, so you don't need to do any of the heavy lifting. Finally, we pride ourselves in providing what we call institutional or investment grade deals, which you normally wouldn't have access to, right? Apart from investing in different jurisdictions and types, you get to decide on the risk profile that you want to go into, right? So we provide you an opportunity to invest, for example, in a building, for example, in an office building in London, or you like to take further risk, we also provide development opportunities, right? So RealVantage is really all about providing investors with a smarter way to invest in overseas real estate. More choices, lower risk, and better returns for your capital. Right? Next up, I think the concept, I would like to emphasize, the concept is only as good as the team behind it. So let me do a quick introduction about the team. So at RealVantage, we have a combined experience of close to 100 years in two main areas, real estate fund management and in data science and technology. So in real estate, my colleagues and I, we have transacted in more than 10 billion in real estate globally and across sectors from residential to commercial assets, right? Throughout our careers, we have taken on roles, apart from investments, we also taken on roles such as asset management and portfolio management, right? We have two esteemed industry veterans sitting on our investment committee, Mr. Anthony Ang, who is currently the CEO of Sasha REIT, and Mr. Richard Tan, the former CFO of Suntec REIT. So these guys will essentially approve, they'll vet and approve the deals that we put up for funding, right? Many of us also have come from esteemed organizations such as GIC, ARA, Barclays Bank, and so on and so forth. Okay. All right, that was real quick. Good. Now let me just hand over to Mark, who will take you through the topic for today. Mark?
Yep, let me just put the screen up on my side. Okay, I hope everyone can see this. Thank you, Keith, and a very warm welcome to everybody here. First up, the reason why I'm wearing a cap is because I've not cut my hair for a long time. I think this is better than presenting a very messy self to you guys, right? So the approach towards this topic of market selection can vary very considerably, right? So for some individual investors based in Singapore, for example, it could be a question of whether you should purchase an apartment in River Valley or Newton, or perhaps in some other location on the city's outskirts, all right? But as you can imagine, it is a very different consideration for global institutional investors that are not constrained by access to markets or opportunities. So for clarity, what I mean by institutional investors would refer to entities like the likes of pensions, insurance companies, large corporates and family offices sometimes, sovereign wealth funds, etc. All right. So as you can also appreciate that, you know, how you approach this question is really a function of what one perceives as the investable universe. And because RealVantage exists for the purpose of expanding this investment horizon for non-institutional investors, including individuals, we will be taking a global approach to this topic. Now, at the very highest level, institutional investors begin by defining their own investment universe, right? So to such investors, there are certain threshold levels that determine if a market is investable or not. So this table is actually extracted from a study published in the International Journal of Strategic Property Management that reveals the factors ranked in terms of importance when selecting markets for such investors. So as you can see, the security of property rights and title, expected returns, liquidity, and market size are amongst the top considerations for such investors, right? So markets that do not meet a certain minimum threshold will automatically be dropped. So I think it's no surprise then that we hardly ever see any institutional investors going to markets like, I don't know, Turkmenistan, Mongolia, Cambodia, you know, stuff like that. Now, while we are on this slide, it is also worthwhile to note that amongst all these factors, some are actually relatively static and they change only very slowly over time. And there are others that are more fluid and dynamic, such as those highlighted in red, right? And in between, there are also factors that could change over the medium term, as highlighted in orange. So this has implications on the market selection, as we will come back again later. Now, for institutional investors, a very purist take would be the way they select the market as a very first cut. They rely very much on a mathematical, or statistical, or financial approach, if you like, driven very much by data and not emotions. And first and foremost, before even getting down to the real estate market selection, they would usually carry out a very robust portfolio optimization exercise across all the asset classes that they invest in. So this would include things like equities, fixed income, and other alternatives such as hedge funds, private equity, commodities, and of course, direct real estate. So this is the process of selecting the best asset allocation according to some of the defined objectives. Now, for example, a defined objective could be like for a certain given risk tolerance level, which is the best allocation that maximizes the returns for this investor. All right. The next step after they have determined the target allocation to real estate, say X number of $1 billion, right? The next round of optimization is then applied to just purely the real estate allocation. And depending on the specific motivations and needs of the individual institutional investors, the optimization is then run on a more constrained model such that the end results are further fine-tuned to arrive at the final market allocations. So in a nutshell, this is a very high-level approach to how markets are being selected by the institutional investors. So just for illustrative purposes, on the right-hand side, you will see a pie chart showing a very high-level allocation across various regions for GIC, our Singapore's sovereign wealth fund. So according to their allocation, roughly half of the capital actually targets Asia, and the balance of that goes towards other regions like the Americas and Europe. And of course, I mean, you can expect that within each continent, there will be more granular and detailed allocations to the specific markets. So as you can appreciate, where the investors are coming from, the motivations and the objectives can greatly affect the results from this optimization exercise. So for institutional investors, in a very recent survey, just last year, of global investors by CBRE, it showed that when it comes to investing in real estate, the global players on average would point towards diversification benefits, stable yield and income, and superior risk-adjusted returns afforded by this asset class as the guiding main primary motivations. Now, as individual investors, perhaps we don't usually think of real estate investment in terms of what is strategic versus what's tactical. But believe me, from the institutional standpoint, it is almost a given, right? So following an investment strategy means that you have a long-term plan, right? It's guided by very defined objectives. And this does not really change much over time, right? Whether virus comes or not, it will be adjusted, but it does not throw the whole strategy out of the way. Now, however, a tactical approach is a lot more dynamic, right? So where market selection is concerned, for example, an institutional investor might have decided it wants to deploy X million into China's tier 1 and tier 2 cities over the next 5 years so that they may gain exposure to growth drivers like urbanization, for example. Now, this is the strategy. But tactically, this investor still has to carefully time his entry into each of the constituent markets, right? So for example, do we go to Chongqing first, then followed by Tianjin, or should we just target Shenzhen first? Now, it depends a lot on which point of the real estate cycle the individual markets are in, as well as a whole myriad of other considerations. So for real estate, this is particularly important because when we target a certain market or a region, it takes a considerable amount of time and resources to build the connections and to understand the markets, right? So because of COVID-19, for example, an investor might tactically pivot from Wuhan to another city for 2020 within China, right? But the larger strategy for China would probably still remain very much in place, okay? Now, beyond the threshold factors, beyond the optimization exercises, right, there are quite a number of other considerations that are very practical in nature that institutional investors take into account when they do their market selection. And I trust that individual investors should probably also do the same thing. But before going into that, it is important that we appreciate that as an asset class, real estate is very unique in several ways, all right, compared to other types of asset classes. Real estate at the end of the day is a very localized business and is very heterogeneous in nature, right? Like, two buildings near to each other, they are very similar in age, very similar in specifications. They can be worth very different values simply because maybe one has a double street frontage. It receives good natural light, it's along a main road, while the other one nearby is facing a side alley, for example. All right. So you can start to appreciate that there can be very significant information asymmetry, right? Where the locals actually know a lot more about the market than a foreign investor, for example. And hence things like industry connections becomes a very important factor. All right. So when I select a market, right, it doesn't mean that I just go for the market with the highest returns, right? If in the highest returns market, I don't think that I'm able to execute, or I don't have the necessary connections there, then I'm not positioned to take advantage of those kind of returns. And I should actually then target another market where I'm better able to manage my risk. All right. So for these reasons, other important considerations are very important when selecting the markets. So some of these will include the size of the investor's own domestic market, right? If the investor has a very huge domestic market that it understands very well, obviously because it's their own domestic market, it's relatively cheap for them to execute in, then there is less need for him to venture cross-border, right? So I think by now you can appreciate that the answer to this seemingly very simple question, like which is the best market, is hardly a trivial one, because simply because the best market for one investor may not necessarily be the best for another one. Now that you have a little bit of understanding how the institutional investors approach this whole question, I just want to share with you some of the interesting results arising from their decisions, right? So we are looking right now at a very simple graphic that shows that the proportion of investors who consider their home markets as the most attractive market out there. And how these results came in is through, again, a global survey of global investors worldwide done by CBRE just last year. So I think unsurprisingly, if you look at the first top few, like US, Australia, and even China, a very high proportion of their own institutional investors find that the best and most attractive market is actually their own domestic market. All right. Conversely, for small markets that do not have diverse sub-markets, the likes of Hong Kong and Singapore, the picture is vastly different. So only 11% of our institutional investors in Singapore say Singapore is the most attractive. And not so much because they don't like Singapore as a country, I am sure, right? But because they're almost forced to go overseas in order to achieve the objectives of having a more robust, diversified portfolio in order to achieve better risk-adjusted returns. So now coming back to an individual investor's standpoint, with RealVantage around, there's really also no reason why they should be constrained to a very small market that offers very limited diversification value. Now, this is another very interesting chart. It's also a survey, but this time it's conducted by Hotwell and Cornell University, also very recent. And it shows a different aspect. What this chart shows is how institutional investors domiciled in different regions select their market focus. So the way to understand this chart is, for example, if you look at the first data point on the very left, it means that for North American institutional investors, 98% of those surveyed have a geographical focus on North America, which is their own market. All right. So this is the way to understand the graph. And I will just point out 4 key points to note here. First and foremost, across the regions, you will find that American and Europe, North America is one of the most sought after market. It is the most sought after market for Americans, and the same goes for APAC investors. And although it's not the top market in Europe, it is it's a second most focused market. All right. And as mentioned earlier, the second point I'm going to make now, again, is a reinforcement that this survey results are very consistent, no matter who conducts it. So American and European investors are very heavily invested within their own respective regions, right? The only one that stands out is APAC, where they are relatively more active as cross-region investors. There's a good reason for this, maybe just quickly, is very simple. APAC as a region is known to be an extremely diverse region, right? It's made up of many other small countries. And so if, as a Singaporean investor, if I'm going to step out of Singapore, do I still want to go to look at a smaller market? Or, it takes a lot of time to understand a market. I might as well just target a market that's larger and is richer in opportunities. So this is just the line of thought, that guides this into the guiding intuition behind this. The last point I want to make is the focus on UK and Australia, to me at least, it stands out very significantly, especially for APAC institutional investors. So if you look across the data points, I know it may not be the highest focus area from all regions, right? But the point should sink in when you consider that the other data points are representing regions, whereas for UK and Australia, they're actually individual countries that show up prominently in this chart here. So that tells us that, these are very heavily focused geographical markets. So this is the last slide I will share with you for as far as institutional investors selecting markets are concerned, right? Again, it's a result coming out of the survey, and it shows that how institutional investors will rank countries when it comes to investing outside of their home countries. So when it comes to investing, as long as it's outside of their home country, the US is now ranked the #1 country destination in the world, followed by UK, and then followed by Australia. So we have a high level idea now of how institutions go about selecting their markets. And I would like to share with you how RealVantage then approached the same topic. Now, given our backgrounds, I think Keith has alluded to earlier, on behalf of institutional investors, we have been investing on their behalf for a while. So unsurprisingly, our approach on many levels are very aligned, to that kind of practice. Now, however, as an online co-investment platform, there are also some differences that will have some implications on how we select our markets. Now, first and foremost, we are not constrained by any specific organizational requirements. So as an example, we are not a pension fund. We do not have to adhere to anything called like the asset liability management considerations. Just to elaborate very quickly, as a pension fund, according to the profile of their members, they have sort of like a schedule of payouts some years down the road, right? So in managing their investments, they need to ensure that the cash flow, the returns from the investments are then able to match the pension outflows, okay? We don't have that kind of consideration. Now, although the way RV functions is similar to all these institutional fund managers, we do not have a specific investment mandate that might restrict us to say, oh, you can only invest in core deals. No, we don't have that. And very importantly, we invest alongside our investors, all right? Meaning to say our interests are very well aligned. When we feel the pain, you feel the pain, we are in it together. We are 100% independent. So why is this important? Because an example of a platform that is not independent is when the platform, for example, is also owned by a real estate player. And the platform is then used to be a channel to generate capital into the projects that they are invested in. So we are not beholden to invest in anything other than deals which offer the best risk-adjusted returns that we are satisfied with. Moving on. The segment below, the market segment below the institutions is the segment that RV serves, right? And it spans a very wide spectrum. So at one end of the spectrum, the investors include family offices. On the other end of the spectrum, we also serve individual accredited investors. So because the investors have varying objectives, requirements, so as a platform serving their needs, when we select markets that are able to offer a wide range of strategies that can cater to this demand. Now, at the end of the day, RealVantage, we are Asian. More specifically, we are Singaporean investors, and as a result, we adopt a very Southeast Asian-centric perspective. Is this important? Well, no, we are sensitive that we need to minimize region-specific idiosyncratic risk, right? Global risk, it hits everybody, so we cannot really run away from that. But we can, through the selection of markets, minimize region-specific risk. So as an example, some of us may recall the Asian financial crisis that rocked this region back during, say, 1997. So while this region went through a lot of pain, the US and European markets hardly actually felt a thing, all right? Moving on to the last point on this slide, we are also different in the sense that RealVantage employs a very data-driven approach, and we also use artificial intelligence in our operations. So that we find that such an approach allows us to monitor a large number of markets in a very timely manner, much more efficiently than if we relied just purely on labor, all right? It allows us to evaluate markets, at least at the very onset, without any bias or emotions. So while we benefit from using this technology, we also have to be very careful that the data inputs that go into our system are reliable, comparable, timely, and of a certain quality. So as a starting point, the very three primary factors that guide our market selection, you can see on the slides here. Now, Keith and myself, we have been active in investment markets that span both the developed as well as the emerging markets over the course of our careers. Now, during this time, we have developed a very acute appreciation of the kind of risk that accompanies markets with very weak regulatory framework. So without naming names now, right, in certain jurisdictions, while there may be laws and regulations in place, right, their interpretation may not be consistent across the submarkets, and certainly not consistent over time as well, right? We, as investors, we can employ the best lawyers to draw up the tightest legal documents, but whether the courts interpret them according to the original intention or not, that is a separate matter. So this is a very important, the strong regulatory framework is a very important consideration. Now, market depth is very closely related to things like how rich the opportunities are. Of course, the bigger the market, the more likely you are to find or unearth good opportunities. And it's also closely related to how liquid the market is. Liquidity is extremely important because for our deals are specific time, they have specific timelines to them, all right? It's very sweet, you know, if you are sitting on huge paper profits, but it is very sad if you are not able to exit the market when we need to exit the market because there's no liquidity. And the market then moves on and then we end up missing the best exit window, all right? So market depth is a very important consideration for us. And the third one would be transparency. Now, when we operate in someone else's market, we never forget that we are foreigners, which is why we prefer markets where foreigners, we are as close to a level playing field as possible with the local players there. Transparency is a very important factor that levels this playing field, right? So transparent markets, as I mentioned earlier, we use AI. It also allows us to obtain the kind of quality data inputs that we require. So just looking across the board, I think you probably wouldn't be surprised that we have chosen the US, UK, and Australia as our primary target market countries, right? Now, the bottom line is, there are reasons why we identify these markets. The bottom line is, we are still seeing attractive opportunities coming up from these markets, and there's very little compelling reasons for us to want to migrate up the risk spectrum. So at this juncture, I would just like to share with you on this slide the results from JLL's Global Transparency Index. Now, JLL is an international top-tier real estate professional services firm, and they have been running this index for 20 years now, and it is in the industry, it is widely recognized and watched by all cross-border investors. The index, yeah, it's called Transparency Index, but it is an extremely comprehensive and extensive index, tracking more than 186 individual elements covering 100 countries, all right? So these are broken down into 6 sub-indices that covers very important areas, as I mentioned earlier, regulatory and legal framework, things like market fundamentals, transaction processes, for example. Now, I'll tell you, the rankings change with every edition of this biannual index. But with whatever the changes are, UK, Australia, and US have consistently maintained pole position. They might play a bit of a musical chairs, you know, from edition to edition, but by and large, they have always been anchored right up there in the pole position. Now, undoubtedly and very sadly, you know, COVID-19 has dominated the headlines and concerns globally in recent weeks or even months now. Its unprecedented nature has generated uncertainties of such a scale that it is difficult for anyone to have any reasonable amount of confidence when it comes to forecasting. All right, forecasting is actually quite important to market selection. So any GDP forecast you see now, whether it's World Bank, IMF, Asia Development Bank, whatever, they all now come very heavily caveated. And even for specific markets, like just take an example, Hong Kong residential sector, the forecast coming from even a seasoned analyst are all over the place now. JP Morgan says the prices will drop 10% this year. S&P says drop 10 to 20%. Morgan Stanley is forecasting a 5% rise. And Citibank is saying prices will rise 5 to 10% from this month onwards till the end of the year. So, I mean, we track these views closely, but at the same time, we take a very pragmatic approach when it comes to market selection. So at this point in time, all I'll say is, the dislocations in markets and the opportunities generated is something that's happening globally, right? But we are relatively more optimistic for markets where we see stimulus measures playing a big part in those markets, all right? As you can see from this pie chart shows out of the total direct fiscal stimulus measures in the whole world, how much does each region or each country contribute to this total, all right? So US is actually, it accounts for 15% of the global GDP, the economy. But when it comes to the direct fiscal stimulus measures, US is punching way above its weight, coming in at 44% of the total fiscal measures around the world. And Australia, I know it's a small slice here. It's actually in orange. It says 3% here, but Australia is actually only accounting for 1.7% of the global GDP, right? So to account for 3% of the total fiscal measures is very big for them. For UK, it's about the global GDP share of about 2.2%. And so reasonably, it's quite in proportion to its, the size of its fiscal response. So together, the three countries that we have sort of at the first level single out, US, UK, Australia, the total direct fiscal stimulus already account for half of the world's response. All right, and this is important that where there are dislocations happening globally, we will be targeting the dislocations that will likely be more short-lived, which is a very big function of how much the governments are doing for their respective countries. Now, just singling out the countries is not good enough, right? I mean, US is a huge country, UK. So to take us to the next level, RealVantage does this, right? The first level I've already been through in depth. The next one, sectors and strategies, is a topic that we covered in a webinar, I believe, probably 4 weeks ago. So back then, in response to the COVID-19 virus outbreak, we have identified certain sectors that we are optimistic and bullish on and offers attractive risk-adjusted returns. And we narrowed down the markets there. Now, based on the sectors and strategies that we have identified, we will then, the next step, have to look at the cities that offers the richest prospects for such strategies, right? For example, I mean, if you are pursuing a core low risk kind of strategy, you won't be going to Cambodia, right? Because there aren't a lot of investment grade type of real estate for you to invest in, right? So you narrow down further to the cities. Now, even amongst all these cities that provide us with very rich prospect, I think I mentioned earlier as well, if we do not have enough confidence that we can execute, or we do not have enough strong partners that we can work together with, then we are unfortunately not placed to take advantage of those. So after we review our own internal resources, our connections, the selection comes down to even a smaller group. All right. So moving on to one of the last slides I have. Okay. Before I move on to the results, sorry, just a quick one. Maybe just to give an idea of how we went through all the various layers in the previous slides. It is a very intensive, not just data, even human attention kind of exercise that we, sorry. That we run a layer of filters, right, according to the macroeconomic data. For our AI-wise, if a market has rents dropping for 3 consecutive quarters and is falling at a faster and faster rate, the system will give us a red flag to say that this market is something to stay away, right? The bottom of the market is some distance away. Or conversely, if the market is rents are falling, but they have been falling consecutively at declining rate, that means it's falling slower and slower. Again, a red flag comes out to tell us this market, we could be very well near a turning point. So this is what the AI system will tell us, but it still takes a human with the experience to go in there to verify if all the factors are in place for a market turnaround. So just an example of how we use AI, because a lot of people don't understand how it's applied. And this is probably one of the most important slides, but it looks simple here. And it's very hard to go into each and every one of the markets. So it's a big topic on its own right. But let me summarize our guiding thoughts here, all right? The selection of our cities is heavily guided by, first of all, we are prioritizing, we are tweaking our AI algorithm to favor fundamentals over distress. Now, why do we do that? Because if we were to enter a market where the market fundamentals are shaky to begin with, even if you're getting very distressed prices, 50% off, 70% off the price, you buy into the market. The question is, will the market have the fundamentals required to turn around, post-COVID days? And we plan to exit in 3 years, 4 years. By the time that comes around, we don't know if we are able to, the market has already reached that kind of recovery. Whereas if you were to go to fundamentally sound markets like the ones I'm showing here, very diverse economic drivers and stuff like that, over time from experience, we know that there's a mean reversion to the markets, and we would eventually be able to exit the markets. We are also, in selecting the markets, we also pivot very strongly to resilient economies. By this, we are talking about things like tech hubs, right? You will realize that the tech sector is one of the relatively less affected sector in this virus episode. Just as a rule of thumb, just as a guide, as a layman way of looking at it, if you go to the recruitment websites today and you see who are still posting, hiring posts, you will find that these are coming from technology firms, fintechs, education, right? So in choosing some of these, like for example, Austin in US, it is a it's a very strong tech colony there. It's anchored by a very reputable, huge university. And these are one of the reasons why we favor markets like that. Now, on the converse side, for example, before this, we actually quite like Seattle market, but it is very important to know that which are the MNCs that are anchored within these markets. Virus or no virus, Starbucks being anchored in Seattle, people will still drink coffee. It's okay. I don't think they will be it's our view that they won't be very badly affected. But Boeing is there, right? And the whole industry is going through a lot of pain right now. And the kind of ripple effects that will come through the city, being such a huge player in the city, right now we have taken that off our list. So we are avoiding all the cities with the headquarters of firms that are very badly affected by the virus situation. And in our strategy webinar 4 weeks ago, we also said we are going for structural factors more than just cyclical. All right, so places that has a very high demand for data centers, places that have growing and aging demographics, that translate to things like assisted housing, or even like offline consumption, translating into opportunities for logistics, for example. So these are the places where we see the opportunities. And so this is like the broad guiding thinking behind the selection of our markets. So this is my last slide now. Just a very quick conclusion, right? So we need to be very clear why we want to invest in real estate, because we want diversification, we want stable yield and income, and we also want attractive risk-adjusted returns. All right, this is our primary motivations. And when it comes to choosing the broad level markets, again, just to recap, regulatory framework, the strength of that, market depth, and transparency, which is why we chose the 3 markets that we chose. And it checks off all the boxes that we want. Now, when it comes to selection of cities, right, I mentioned earlier, fundamentals over distress, pivoting to certain resilient economy or market drivers, and favoring structural more than cyclical. And I think with that, I've come to the end. How should we do this? This is a Q&A.
All right, feel free to post your questions on the Q&A box. Okay, we have one question here. Are the current assets that your company is holding affected by COVID?
Okay,
Okay.
okay, you take that one. Okay.
Sorry, go ahead. Yeah, yeah.
So we have deployed into five opportunities to date. And has it been affected? On the margin, I would say there probably will be some impact. The extent of impact remains to be seen. But let me just say this. All our projects have gone into very rigorously researched process. And whenever we go into a market, it's also because that we go into it because it has the best supply and demand dynamics, right? In such supply constrained markets, even if the prices were to come lower than our previously expected prices, we would think that such markets would probably be more resilient as compared to a fringe market that is oversupplied. You know, the prices are coming off the cliff, right? So far for our projects, we are very fortunate. We are watching the data very closely, and the market has held up. And even for some markets like Sydney, prices for residential has still continued to inch up. So from that regard, from that angle, I think we are still fairly well positioned so far for our projects.
Okay, we have another question here. How is this investment structure compared to REITs? All right, that's a good question. We have always been compared to REITs. To put it simply, obviously we are not listed on the stock exchange. Our products are not publicly traded in that sense. We invest in our assets through what we call SPV structures. And when you invest into a investment, you come in as a shareholder of a company, and this company is the one that owns the asset and nothing else, right? So that's how we typically structure all our deals. We have clear line of ownership to the asset, right? Whereas compared to a REIT itself, obviously, you go in through the stock exchange, right? That's how you do it. But similarly, that allows you the flexibility of going in and out. For us, we do not have that flexibility for you to go in and out. However, we do allow trade outs, but that's provided we are able to secure an investor to take over your position, right? Actually, we have an article written on this, so we'll guide you to come to our platform. We wrote a whole comparison between us and REITs, right?
I think I just quickly, while we're on this topic, very quick comparison. Liquidity-wise, in and out, of course, the REITs will be better. I think Keith already mentioned that, right? The problem is this: what is your objective of investing into getting exposure in real estate? Statistically, REITs have a correlation of about 0.7 with the larger stock market. So if you're already exposed to the stock market and you think that I want exposure because it helps me build a more robust or more resilient portfolio, then maybe REITs does not serve that purpose as well, right? Now, REITs are also mandated to pay out 90% of their cash flow. There's a very low threshold to which they can participate in development projects and opportunities. And that means that if you are investing in REITs, you will not have access to, for example, some of the projects that we have done. You will not be able to participate in value-add opportunities or development ones. So the other question is, for example, REITs, one of the REITs has a big shopping mall in Orchard. Then the other asset in the portfolio is office in Milan. And the question is this something that you like? Maybe you like the mall in Singapore, but you don't want to be exposed to the mall in Milan, right? Then do you have a choice? The answer is no, right? But if you are doing through a platform, co-investment platform, you know exactly what you're getting exposed to, and you can control and get exposure to the kind of opportunities that you think fits your profile, right? So just a few points to note.
Okay, the next question we have is, what are the risk levels like investing? Okay, Okay, that's a good question. Well, on our platform itself, we organize our deals into 3 different pockets, starting with core deals, which are essentially lower risk deals. These are income producing assets with secured tenancies, right? And then next up the spear, we have something called value add, where this usually involves assets that needs a bit of asset enhancement, or there could be some mismanagement. That's where it provides higher returns, higher than core deals, but it entails a higher level of risk. And right up the spectrum, we have something called opportunistic deals. And this means there's a fair level of risk, and it will generate higher returns. Now, what is risk that we're talking about? There are many types of risks, right? In real estate, usually we look at a few key risks. We have market risks, interest rate risks, credit risk, means pertaining to the tenants, and simply regulatory risks as well. These are the few key risks that we look at now. So when we talk about things like risk-adjusted returns, what does that term actually mean? I think many of you might have that in your mind. What do you mean by risk-adjusted returns? So what we are saying is that the returns has to commensurate with the amount of risk that's taken on the project. Okay, so like I give you an example, let's say it's an income producing asset fully secured by a national tenant for the next 10 years. Well, the risk of income, the risk of shortfall incomes is much lesser. But at the same time, when you look at a development deal, right up the spear, you have many risks to worry about. You have to worry about cost overruns. You have to worry about whether your units can sell, right? So, and also there could be interest rate that could affect your returns. So there's a fair level of risk. So when you go into a deal like this, you would naturally expect the returns to be higher. Yeah, you wouldn't want to enter into a development risk and expect a 9% return, for example. You can get that as a simple core deal. You can get 7 to 9% returns. But when you take a very risky project, a riskier project, you expect to at least generate close to 20% returns. That's what we mean by risk-adjusted returns, right? Okay.
I think some questions actually came through the chat rather than Q&A. All right. One of them is a bit more straightforward. Will you guys be considering Japan? At the moment, no. It is a very good market though. I like it. But if you compare Japan, say, with Australia, for example, right? The reason why people find Japan attractive is because the yields are actually quite high, vis-a-vis the borrowing costs. And going forward in the foreseeable future, we see the same type of levels of yields at also very low financing costs in a country like Australia, for example. So I think to satisfy that kind of investment demand right now in our markets, we do have that kind of opportunities. So I think as a team with certain kind of resources, we have to be focused, right? So that we can execute on a localized basis. So good market on a KIV list, but probably not in the near future. This is my answer. The other question is, what are your charges? Our charges vary. For core deal that Keith mentioned earlier, core deal means already has a secured tenant, doesn't give us problems, very strong tenant. You are collecting rents every month. Now, this is a very light asset management effort. We do not collect asset management fees as much. There's typically an acquisition fee, depending on the nature of it, then the asset management fee, and there's a performance fee at the end of it. By and large, we are in the region of about 5%, I would say.
Just to add on the fees, yeah, it's usually structured in a manner that a lot of it comes from performance. So we would put forth a projected returns, and we take fees only above that projected returns. That's how we structure our deals. So you have a preferred position in that sense.
I think one point to add is for every different deal on our platform, we are quite transparent in telling people how the fees will be generated or what kind of fees are payable. So, you know, it's all quite transparent there. Okay, back to the Q&A panel. What's your view on the US market if COVID sustains for a longer period? Yep. It is. I mean, I think in a research article we put out, we did observe and noted that amongst most of the countries, we are actually one of the most worried in terms of US that things might drag out for the longest time, and that therefore the damage done to the economy is deeper, right? At the same time, we are expecting more dislocations to come out from that market as compared to a market like Australia, where on a relative basis, they had lockdown, but the lockdown was well managed. Now they are already coming back to out of the market. The damage done to the economy is relatively less. Now, so therefore you would expect the pricing in Australia for most of the assets will probably not offer you the same kind of discounts that you can expect for some of the US markets. So I guess at the end of the day, it's a very big question, but I would say like we need to be careful how we price the entry. So for US market, I already said, we are very well aware of the risk that this is going to drag. Therefore, our pricing, when we go into any project, would have already priced this in to get a fair entry point, and it accounts for the risk. I think this is a very short answer I can give for a big question like this.
Okay, can we take one last question? If anyone has any last questions? Okay, what is the minimum investment time frame and the distribution frequencies of returns? All right. It's a really deal by deal basis, but I will put it this way. For usually core deals where it's income producing stable assets, where the tenant is secured, we will look at a 3 to 5 year horizon. And that includes regular distributions. We distribute the rental proceeds, the net rental proceeds on a quarterly basis, right? On some deals, like recently we did a deal in Australia. It's a development townhouse project. That will take slightly above a year. Because it's a quick turnaround. We are involved in that deal in terms of the financing of the land, and there's only 9 townhouses to sell. So we expect a quick turnaround that will be done within a year, right? So it depends on the nature of the asset. Some might require more work, and some might require a bit more time for the market to recover, right? So, but typically I would say it ranges between 3 years to 5 years. That's a time horizon. It's important to sort of educate our investors on time frames. Real estate is not an asset class that you go in and out fast. There's a fair bit of transaction costs when you go in, acquisition costs, stamp duty, and so on and so forth, right? And it takes a while for the asset to work to reach optimal. So investors, when they invest with us, are encouraged to say the cost, and they need to understand the time frame involved, right? It's not like equities, right? It's not like REITs where you can turn around and go in and out fast, right? So it's an asset class that you need a period of time. Some of the institutional funds out there, they go up to 7 years, or some even 10 years. Some core funds are even all the way up to 10 years, right? Okay, excellent. I think there are no more questions. All right, excellent. Once again, I would like to thank everybody. Mark, okay, one last question, maybe Mark, you try this out.
Okay, let me see. Do you expect the recent Fed measures to lead to a significant asset price? Yeah. Okay, very good. It's not just the Fed measures. We have somewhat been here before after the GFC. All right. I mean, I'm not saying it's the same, right? But we have been here somewhat before because the amount of liquidity that was sloshing around, following all the stimulus measures, and following the quantitative easing certainly went a long way to inflating and pushing up and supporting asset prices in the wake of the GFC. Now, coming into the virus situation now, we are on a totally unprecedented scale. All right, the amount of stimulus measures that's been pumped in so far, and I won't be surprised if there are some more, measures coming on board. It's just on a totally different scale altogether. And where will this money go in the years to come, right? So I believe, as the markets try to get back to normalcy, this is going to take years. The central banks or the governments will probably not be able to pull back the liquidity as fast as they would like to, or return interest rates to the levels that they would like to return to. So, short answer, yeah, I think we should be getting more accustomed to more compressed cap rates going forward. So if you think, buying a Sydney office at 4.5% was expensive before the virus, once the dust has settled, I think don't be surprised if you can see prices, the cap rates that come down to even 3+%. I won't be surprised. So I hope I've answered that question satisfactorily. Yeah.
Okay, excellent. Once again, thank you so much, guys, for tuning in. We'll be conducting a few more webinars in the coming weeks. We hope you take the chance to join us. Okay, thank you very much, and good night.
Thanks, guys. Have a good evening.